Welcome back to The Edge in our ongoing series of the setups, this one called Head Fakes. So how we like to start most of these chart images is back to a bird in the sky. If this was in fact a bird in the sky and it left a trail, what would it look like? Market moving up, back down, back up, and then falls off the side of a building in there. That's how your eyes have to get fixated on every chart you now watch. Now, with that being said, whatever your time frame, head fakes is a real neat dynamic of other people getting stuck. What's really important once you come to the right community like The Edge, in a prop firm type environment, is forget about how you're thinking. How are other people with open positions thinking? There's always individuals with open long positions and open short positions. Remember the saying, after you buy it, you're a seller. After you sell it, you're a buyer. People who are long are sellers. People who are short are buyers. So let's look a little deeper into this image and assume again this is a down bar. This would be an up bar. These tops, let's call them, you could almost circle them and then draw a line through them like in here to define potential top of consolidation. Then you could look at these lows down in here, and also if you were to draw a line and connect them, you could see that as the bottom of consolidation. So this is essentially a range, the top of the range being up here, the bottom of the range being down in here. Now let's just for a second take this area and assume that those who are short are going to look and say above this line in here is where their buy stops are going to be to cover their short for, at this point, a losing position. Furthermore, those that are long might put a sell stop below this line to exit that long position where they would then be or admitting that they're wrong. So looking at that for a second and seeing the top and bottom of consolidation drawn in here, once the market starts to move up, if you follow this illustration, and gets close to where the shorts are going to get stopped out, it's safe to assume that in fact when it goes up a little bit outside the previous line in consolidation, that those shorts are being shook out. When you shake someone out, that's a trader taking their loss. When you shake out shorts, that means you have less shorts. What does that equal? Less shorts equals less buyers. Now that's going to be important to start to stack probabilities of the next right side of the market. Stay with us on this. Less shorts because they just got shook out of this market and their buy stops got elected, means there's less buyers below. Then this market, when it's approaching this line and does rally up through here, you start to attract momentum breakout traders who would then open up a long position thinking, wow, this market going to break out this consolidation and run all the way up here. Let me get in, let me get long. That's what short-term momentum breakout traders want to do. In this case, open a long position. What do more long positions mean? That equals more sellers. So when you shake out shorts, you have less buyers. When you invite and accumulate more longs, you have more sellers. What does the market do? In this image, the market rallies up to here and then wham, comes right back into the middle of the range, indicative of this illustration. When you get that dynamic to play out, the next right side of the market is most likely, in this case, down. Why? Because of this dynamic of less shorts, because they were shook out in here, means less buyers below. More longs who are stuck because it went right against them in here, and now they're the sellers that stack the probabilities that it's going to move down. If you were long and stuck long in this market, and it just did this, and it's trading in here, where would you put a sell stop? And most of you would admit that you would draw a line through the bottom of consolidation and you would say, I'd put my sell stop right below that line. Well, guess what? So did many other people. The market rallies up a little bit and, indicative of these reds, shoot back south and sell off. That's a head fake. Just to go over it really quick, It rallies in here, shakes out some shorts, meaning less buyers, sucks in some longs, meaning more sellers, comes back into consolidation. The longs have grapefruit eyes saying it was supposed to rally and keep going up on this breakout. It didn't. I have to put my sell stop below the consolidation, and that's the dynamic that allows you to stack your probabilities that the next right side of the market is down, because you're starting to think like other traders instead of just thinking like yourself. This is a head fake moment that markets do all the time because it's their job to shake you out.